Hey, it's time for Ask Annex. As always, got a question, you head to our website, annexwealth.com. Look for the Ask tab. If we can help, you click that Get Started button. Fred Coleman's a wealth manager, also a CFP at Annex Wealth Management. Welcome back.
Thanks, Danny.
Matt Morzy is Director of Research, also a CFP at Annex Wealth Management. Hello.
Hey, Danny.
Question 1 on Ask Annex this week. I love this. I'm closing in on retirement. I have ample cash reserves and would like to add to my HSA balance. Can I put my entire paycheck into my HSA?
That sounds like a nice luxury to have. You can do that as long as you don't go over the maximum, which is around $4,100 per year for individual and a little bit more for a family. But some things to think about is just how does that HSA work with Medicare? It doesn't work. Medicare and HSAs don't mix. So if you enroll in Part A or Part B, you can no longer contribute pre-tax dollars into the HSA. And then when Medicare begins, you should change your HSA contribution to $0 per month. Also, if you're over 65, you could automatically be enrolled in Medicare Part A. And one thing to think about is if you do decide to delay enrolling in Medicare, make sure you stop contributing to the HSA at least 6 months before you enroll in Medicare because it's retroactive. So it looks back 6 months. And if you don't stop your HSA contributions before those 6 months, then you can incur a tax penalty.
Nobody likes those.
Oh, no.
No. Question 2, Ask Annex. Are target date funds worth the extra cost? Morningstar says the average is 0.68%. I thought they were just kind of putted along all by themselves. Why the extra cost, Matt?
Well, there's a lot that goes into it. So, just to take a step back of what a target date fund is that generally they're going to be an employer responsive plans like a 401k, and you're going to have different vintages. So there's, it's a 2025, a 2030, 35, 40, all the way. I've seen all the way, I think, to 2070 at this point. And the idea there is that you put money into your 401k, and instead of managing it yourself, you use this target date fund, have a target retirement year for you, and then you just kind of let it sit. And you're right, from an investor standpoint, they are just puttering along. But what's happening underneath the hood is that whatever firm is managing that is actively managing that to an extent. So as you get closer and closer to retirement, you're becoming more and more conservative. They're also changing the mix of how are you allocated on the equity side, how are you allocated on the fixed income side. And they're not investing in individual stocks or individual bonds to do that. They're investing in different mutual funds or ETFs underneath that wrapper. They have their own internal expense ratio, so that's part of that. Their management fee as a firm to manage it as well too. So it certainly does add up, and that's about the number I've seen too from an average standpoint of looking at it. And really, what you're paying for is the simplicity of just having somebody else do it for you, which for most people is really the best way to attack it.
Yeah, and I would argue that the asset allocation is more important than the cost. It's very important to make sure that you're allocated across the board how you should be, depending on your retirement date. So that's what those funds do. So I wouldn't just look at the actual cost, but also look at what it's doing underneath the hood.
A 2070. I'm going to jump on one of those so I can retire at 110. Right? That's crazy.
You love your job, right?
Final question on Ask Annex. Are there any services that can assist in determining an ROI on a college degree? Okay, somebody's concerned about somebody else's choice on a college major.
100%.
Yeah, college is getting more and more expensive. It's something if you work with a wealth manager or advisor, they can help with. But the thing to think about is that it's different for everyone. It depends on what your career is, what your potential earnings are, where you're going to be going to school. At some point, it's going to be a break-even point. The difference between going to college, you're going to incur some debt with hopefully having higher career earnings in the future, or you can just start off in a career right away and, your earnings could be more than a college degree. You never know. So it all depends on, what your potential career earnings are versus the debt. And then, sometimes you can take into consideration some things that aren't necessarily math related, some of the intangibles that go with going to college as well.
It's also one of these things that you got to weigh. The trades are hurting for people, right? And we got to get at the trades in the United States. And these kids that get into these programs that are out in a couple of years with very little debt, and they're doing really, really well.
They are. One of my brothers works in the trades, and he talks to me, pretty consistently about the people that he hires and the level of education that's needed and the ability that most of these firms are able to train those employees. So you get hired on day one, you don't necessarily have some of those skills right away, but they'll train you and build you up. Like Fred, you mentioned too, if you start working right away, you start getting an income immediately without having to, borrow money or deplete savings to go to college. So for many, many people, that's really the way to go. And you're right, Danny, we have a shortage of people who move in that direction from a career path standpoint. So there's always really high demand there.
You can't AI an electrical job. You cannot. All right, Fred Coleman, Wealth Manager, CFP, Annex Wealth Management on Ask Annex. Thanks.
Thanks, Danny.
Matt Morzy is Director of Research, also CFP. Thank you.
Thank you.